The main point of involving yourself in dividend investing is to generate enough passive income from dividends to be able to one day retire on that passive income. Certainly, total returns are another big part of the equation, especially for younger investors like myself, who's in my mid 30s. But even still, the goal is to build an ever-growing stream of passive income, because the belief is if you buy quality companies that pay attractive dividends and consistently grow those dividends over the long term, you're going to end up getting very attractive total returns. And so with that in view, in today's video, I'm going to look at 3 different dividend investments, 2 of which are stocks and 1 of which is an ETF that I believe are very well positioned to pay not only consistent and attractive dividends, but to grow those dividends year after year after year for decades to come, thereby making them great foundational pillars for a dividend growth portfolio. I'm also going to take a look at them to just let you know if I think right now is a good time to buy them or not. So the first one is going to be the Dividend ETF. It's the Schwab US Dividend Equity ETF. It's ticker symbol SCHD. And this one is obviously quite popular, and for good reason, because it has an expense ratio of just 0.06%. That makes me think of Warren Buffett's famous quote, "Performance comes, performance goes, but fees are forever." And when you're looking at a passively managed fund, it's particularly relevant because you're not looking for any kind of investing genius or any kind of superior active management strategy. You're simply looking, does it have a good quality portfolio of dividend growth stocks, and does it charge as low a fee as possible so that you get to keep as many of the returns as possible? Well, SCHD certainly passes that test, as it only charges a 0.06% expense ratio, which is among the very most attractive in the entire dividend ETF space. Next, we see here on the funds page itself what its goal is, and it simply looks at some of the highest quality dividend stocks. And how it does that is, you can see where it has a very good quality portfolio. Its top holdings include several biotech/healthcare stocks like AbbVie and Amgen and Merck. And so that makes it quite defensive in the face of a recession. In fact, if you look at other names like PepsiCo and Coca-Cola and Altria Group, those are also extremely defensive in nature. And then you even have Lockheed Martin, which, since it's a defense contractor, its contracts are with the US government and they're defense oriented, so they're considered highly mission critical, and therefore it also tends to be very recession resistant. So you're seeing already in its top holdings, which make up about 40% of its total portfolio, actually a little bit more than that, that it is a very defensive investment. Above, we can see also how many holdings in the portfolio, and that's 103. So it is pretty well diversified. You get over 100 blue chip dividend growth stocks in your portfolio, with the top 10 being highly concentrated in defensive names, with really only Cisco Systems, which again, that's as much enterprise tech play, which is some nice diversification, and then Home Depot and Chevron, which are also blue chips in their own spaces. Chevron, which owns a lot of energy assets, including natural gas, which that means it should do quite well from the AI boom over time. And Home Depot, which is a leading retailer for home improvement, which has also proven to be a phenomenal company over the long term. You can see the sector breakdown here: heavy concentration in energy, consumer staples, and healthcare. These two are very defensive. Energy is much more cyclical, so you get some good balance there. Then you have industrials, information technology, financials, consumer discretionary, communication services, and materials. And these are all pretty quality as well. Now, what do I like about Schwab besides these things? SCHD, as we can see here in Forecaster, which is a AI tool that I like to look at when analyzing stocks and funds to figure out how to purchase them. We can see some really important insights here about SCHD. First of all, we see that it has consistently grown its dividend over time, and it gives me that quick analysis here with the green to show consistent growth. And in fact, it's grown its dividend every year since it's been in existence, and over the past 10 years alone, it's grown its dividend at an over 10% annualized pace, which makes it very, very attractive. Additionally, its current dividend yield is about 4%, which makes it one of the more attractive dividend ETFs out there, much higher than what's offered by peers like VYM, VIG, DGRO, DGRW, and certainly higher than what the S&P 500 offers right now. Now, we can look at some other features here on Forecaster. For example, there's a projection here, and this uses AI technology along with past history and some technical analysis to forecast how it's going to perform in the near future. And you can see here that there's a 67% chance that buying here is going to be profitable in the coming months, whereas there's a 33% chance that it will not be. Now, the robustness here simply shows the degree of confidence in this projection, and so it tells you why. And so you can break that down for yourself to determine if it's going to be. And then it says that the projection is moderate. So that means there's a good probability that it will be profitable, but it's not guaranteed. Now, I'm not a short-term trader. I'm a long-term oriented dividend investor. So this one right here really does not matter a lot to me. But if you are a short-term investor / trader, this feature could be really valuable to you. What I like much more is the overbought, oversold indicator. And that tells me more what is the market's mood currently on it. And that tells me if I'm more likely getting a good bargain or not. And so I generally like it when it's on the lower end of neutral or ideally even oversold range, because that tells me likely that in the case of an ETF, its underlying holdings in aggregate are have negative market sentiment, which generally means that it's being overly bearish, and therefore I'm probably buying on a good value basis because I want to hold this for the long term and get good dividends. Now, obviously, the high dividend yield of 4%, it's on the high end of the spectrum for SCHD anyway, based on its history. And so that alone tells you I'm probably getting a good deal. But this also indicates I'm probably getting a pretty good deal because while the market mood overall is neutral, we can see it's on the low end of neutral and almost into oversold territory. So I think that right now is probably a pretty good time to be buying some shares of SCHD. Again, because you're going to get that 4% yield, you're going to get that 10% annualized growth rate over the past 10 years. Even if that slows a bit, you're still going to get inflation beating income growth and likely a pretty attractive total return. And I also like that the portfolio is fairly well balanced, with especially some emphasis on more defensive names, given that we do have some concerning economic indicators out there. Okay, so if you like this kind of content, please make sure you like this video and subscribe to the channel for more deep dive dividend analysis like this. I put out several videos a week that cover ETFs, CEFs, individual dividend stocks, as well as my overall macro outlook and even some of my investing strategies and philosophies. Okay, what about the next stock? Well, the next stock I'm going to talk about is Enbridge. And Enbridge is a leading midstream company, and it has a lot going for it. In particular, it has a very strong defensive business model. As you can see here on their most recent investor presentation, they highlight that they have 80% of their EBITDA is inflation protected. And not only that, but 98%, in fact, over 98% of their EBITDA is either regulated or take or pay contracted with investment grade customers. That means it's very utility-like in its cash flow generation capabilities, and it has virtually no exposure to commodity prices, with less than 1% of EBITDA having that exposure. So you're getting a very stable utility-like cash flow stream. In addition, it's well positioned to benefit from rising energy demand. In particular, Enbridge has invested aggressively recently in boosting its natural gas footprint. And so that means it's positioned to benefit from the AI boom and data center power demand growth. So here you can get a utility-like AI play from energy, and that's also going to give you a good dividend yield. And we'll get into that in a second. And so here you can see how much growth potential they have right now across their portfolio that they're using to take advantage of power generation demand. Another thing I really like about the business is that they have a clear growth outlook. So over the next few years, they expect to grow their EBITDA at a high single digits rate, and then over the longer term at about a 5% annualized rate. And they expect their earnings per share and distributable cash flow per share to likely be in a similar range. And the dividend per share is likely going to line up with that as well. So we can expect probably over time a 3 to 6% annualized intrinsic value growth for the business on a per share basis. And you can see here the capital allocation priorities. They're bringing down their leverage to a very sustainable rate. Their leverage target is between 4.5 times and 5.0 times debt to EBITDA. They're already there, and they're even moving further down on that spectrum to give them additional financial flexibility. Their distributable cash flow payout ratio is already within their range, so therefore they should be able to grow the dividend, such as they have for the past quarter century plus, which makes them a dividend aristocrat for many years to come. Now, when you combine all that with our forecaster analysis, which shows that, first of all, on an overbought, oversold basis, it is an oversold territory. So that tells me that it's likely undervalued. And then you also look at the fundamentals for the company, and you can see here it gives a really attractive dividend yield. That's on a trailing 12-month basis. It's actually a little bit higher on a forward-looking basis, closer to 6%. Very attractive from a utility-like cash flow stream with such a consistent dividend growth track record, as we just discussed. And you look at the different valuation models here, and based on virtually all of them, see the current price is $47.08. It is undervalued based on every single valuation model, the Peter Lynch model, the EV to sales, the economic value added, and the discounted cash flow model. And so on an average basis, it's 28% below the fair value estimate based on its current price. And so there we can have additional confidence that we're buying this at a good time. So both the technicals tell us that it's an oversold territory, so the market is likely too bearish on it. The valuation models, which generally take a longer term perspective, also tell you it's materially undervalued. And we can see in the fundamentals, it's very defensive, stable cash flow stream. It's attractive dividend. It's solid inflation beating dividend growth track record. And it has a solid investment grade credit rating of BBB plus with leverage well within its target range. And so all those indicators tell us that Enbridge is very likely a good buy right now. Now let's look at our final opportunity here, and that's Realty Income, which is a triple net lease REIT. It's also very well known. It has been extremely stable throughout its history, and we can see some of the stats here. In 29 out of 29 years, it has generated positive total operational return, which is simply just the annual AFFO per share growth and the dividend yield. And so it has never shrunk its AFFO per share to a degree that would fully offset the dividend yield in any given year. And in fact, its median annual AFFO per share growth rate is a 5.5% since 1996. So very, very solid inflation beating growth. It's generated 13.5% compound annual total return since it went public in 1994. And its average, not its median, but its average annual dividend growth rate since it's going public has been 4.2%, which again is inflation beating. And its 30 years of consecutive monthly dividend payments and consistent growth make it an S&P 500 dividend aristocrat. So very, very dependable dividend payer. Has a rock solid balance sheet, A3 stable from Moody's, A- stable from S&P. And so when you combine all that with its thousands and thousands, in fact, over 15,600 properties diversified across all 50 states in the US, the UK, and 7 other countries in Europe with single tenant net lease contracts, it is a very attractive risk adjusted investment. And we can see here as well just how stable it's been compared to other investment indexes like the S&P Dividend Aristocrats, the Dow Jones Industrial, top consumer stable firms. So what that leaves us is simply let's go look at Forecaster to see if right now is a good time to buy. We can see its dividend yield is 5.4%. And again, that's on a trailing basis. Looking forward with some dividend growth, that's going to be probably at least 5.5%, if not higher. We can see on a valuation basis, it is undervalued. Now, there is some uncertainty here because their discounted cash flow assumptions seem unrealistically high. But even taking that one out of the equation, which is what this analysis does, the Peter Lynch model indicates it's right around fair value, and the EV to sales indicates it's meaningfully undervalued. And so we can be relatively confident we're not overpaying for the stock, and there's a good chance it's still undervalued depending on what you do with the discounted cash flow model there. Now let's look at the technicals to see if it's a good time to buy it or not. It's neutral. So that means the market is not overly bearish or overly bullish on it. So what this is telling me is that right now, Enbridge is probably the better buy because it is a very attractive buy from both the technical standpoint and the valuation model standpoint, whereas Realty Income is neither a particularly compelling buy or sell based on the technicals, and it's only slightly undervalued based on the valuation models. And so I would say that Enbridge is definitely a buy if you want to maximize total returns. Realty Income, you're not overpaying for it. It's still a solid buy if you are simply looking for an attractive dividend growth machine over the long term. But if you want to wait for a greater margin of safety, that probably wouldn't hurt either. You can just wait for it to pull back in the future and see what it does. And in fact, if we look at the projections here, it's indicating with a high degree of probability, with strong conviction, that it is likely going to go down in the near future. And so perhaps that should be the deciding factor that maybe Realty Income is not a good buy today for people who are focused on maximizing total returns. But again, from a long-term perspective, I don't think that now is a terrible time to buy the stock because it is not overvalued in my view. It still pays an attractive dividend and the business itself is so strong. So hopefully this video was helpful for you and getting a sense of what kind of stocks that you can count on for long-term income growth while still getting an attractive current yield and being able to sleep well at night as you build a well-diversified, well-oiled, dividend-powered machine. And of course, as I hope this video also pointed out to you, that there are some useful tools out there like Forecaster that you can use to determine is now a good time to buy or not in terms of the technicals as well as the valuation over the long term. So I will be leaving a link to Forecaster in the pinned comment as well as at the top of the video description. So I encourage you to go check that out. You can even get a 10% discount if you just subscribe to their paid version using my unique link. Thank you very much. See you next time.